So on this channel recently, like the last year, I've been doing more selling of my stocks and my investments, but I have finally bought a new stock and I started researching this stock a year ago, put it on my watch list about 6 months ago, and after seeing positive earnings report quarter after quarter, I decided I wanted this stock in my portfolio, and now it is. I bought a sizable amount and think this will be a great long-term winner for me. So the stock I bought is Health Equity. Now its ticker symbol is HQY. Now many of you right now probably have never heard of this company, so let me introduce you. It was founded in 2002. It's in the healthcare sector and the healthcare providers and services industry. The company offers cloud-based platforms for individuals to make health savings and spending decisions, pay healthcare bills, earn wellness incentives, grow their savings, and make investment choices. Now, the main thing you need to know is they are the #1 health savings account administrator. I don't know if you've heard of an HSA yet, a health savings account or not, but these things are growing in popularity, one of the big reasons why I have invested. So HSAs help people save for medical expenses by allowing them to deposit money from their paychecks pre-tax, and additionally, assets in an HSA account can be invested. You like investing? You can do it through an HSA account. And the gains accumulate tax-free as long as the account is used for qualified medical expenses. In other words, HSAs are similar to retirement accounts and IRAs and 401ks, except they are targeted towards saving for healthcare expenses. In order to qualify for an HSA account, a person must be enrolled in a high-deductible health plan that supports the HSA accounts. A person with a high deductible plan generally pays lower premiums, significantly from what I've seen, to maintain their health coverage, but has to meet an annual deductible each year before medical costs are fully covered by an insurance company. So you still have a plan. You're not saving and you don't get covered at all. No, there's still coverage, but you just have a higher deductible and threshold limits and stuff like that. So a high deductible plan can do good because they offer a financial incentive for patients to only visit a doctor when they really need to, compared with lower deductible health plans. This makes high deductible health plans more cost effective for employers, and they can also be more cost effective for patients if they do not have high medical needs. As a result, high deductible plans are growing in popularity. So what are the main advantages of HSAs? Well, balances are not subject to the use it or lose it rule, which FSAs, if you've heard of the flexible spending accounts, you have to use that money by the end of the year. But with health savings accounts, no, they just roll over and continue to grow and grow and grow year over year. Now there's the opportunity to save for future qualified medical expenses, including in retirement. We're going to talk more about that. Now most employers offer a company contribution, so that's a benefit, free money. It's a convenient vehicle to save for out-of-pocket costs with an HSA eligible plan. The best thing about HSAs though, the absolute best thing, is they are a triple tax advantage account. So contributions, earnings, and withdrawals are all tax-free. I don't know of another account like this. If there is, comment below, but this is highly advantageous and why I think a lot of people should take advantage of this. So for 2024, like anything else, there are contribution limits, and for HSAs, it's $4,150 for individuals and $8,300 for families. As you'll see here, it comes with a great, fantastic app. I will tell you more, but I do have an HSA myself, and the app for Health Equity, which is the company that services it, is excellent, and it comes with a debit card, which you can use. So if you go to the doctor and you have a copay, you can use your HSA account and just swipe it and pay for it, and it just reduces the balance in your account. So you save, you spend, and you invest. The thing you want to do with your HSA is you want to build these funds up. So what I recommend, if you have one, is do not touch the funds in here unless you absolutely need to. Because like with any investment, you don't want to touch it, you want it to grow. And again, you can invest this money, which is a huge benefit. Now, speaking of investing this money, what happens is, I think it depends per plan, because I've heard of different thresholds, but let's say the threshold is $1,000. You have to save up at least $1,000 in your HSA, and then anything above that, you can choose a low-cost Vanguard fund to invest in, and that is fantastic. So you're growing, you have the opportunity to grow your money that you save at a higher rate, therefore increasing the amount of savings you have to cover future medical expenses or use as another retirement account, which we'll talk about here in a second. So to be able to invest, which we all love to do if you're watching this channel, is fantastic. Now the partners they work with are employers, health plans, and benefit advisors, and they offer these products. So they have the health savings account, which is their bread and butter and what we're mainly talking about in this video, but they also have flexible spending accounts and the health reimbursement arrangement, and other benefits such as dependent care, commuter, lifestyle, COBRA, direct billing, and premium only plans. So this next point is very important. Health Equity is the largest HSA provider with over 5.5 million HSA members, over 11 billion assets under custody, and working with over 50,000 organizations. Now, what I want to highlight here, when I invest in a company, I'm looking for that wide moat, that competitive advantage, a company that has a monopoly or a duopoly, and this is it. Health Equity is the largest provider. This is where I see the strong moat of this company. They are already a leader, have a competitive advantage, and I think it will stay that way. Usually when you cross that finish line as a clear winner, you stay first place for a very long time. It's very hard to disrupt. Think of Amazon with Amazon Web Services. Think of Google with Google Search. So this is a great thing to have when you invest in a company, and it's making sure they have that competitive edge, which Health Equity does, so fantastic. Now that's just HSAs, but they have the other offerings. So in totality, they serve over 14 million members, over 120,000 organizations, over 10,000 registered benefit advisors, and over 185 network partners. It is a health savings account focused business, but with those other offerings. Now let's talk about their recent earnings. What I did here is I highlighted in green anything that beat analyst expectations. Anything in yellow means it did not beat. So total HSA assets beat analyst expectations. Total HSA investments beat analyst expectations, as well as HSA accounts. Now the total HSA cash did come in slightly below estimates, but again, it is still growing. I'll show you that here in a minute. Now total accounts beat analyst expectations, and so did the CDB's accounts. Now let's talk about revenue expectations. They have three different ways they earn revenue. So with service revenue and interchange revenue, they beat analyst expectations. With custodial revenue, it came in below, but it still grew 26.3% year over year. That is fantastic. So let's look here. Again, anything in green means it went up when comparing the same time frame from a year ago. So we have the 3 months ended January 31st and the year ended January 31st. The only one in yellow is service revenue. When comparing just the 3 months, it went down 1%. But if you look year over year, it grew, it went up, and that custodial revenue is the one that's really growing fast. So let's talk about these different streams of revenue. Now, Health Equity is able to collect fees for administering each account. In addition to getting paid a small fee for each HSA account it administers, Health Equity generates revenue from the assets held in each account by collecting interest and administering investment programs. So for example, if an HSA account has $10,000 in cash, the company sweeps those funds into an investment program that invests in bonds, and Health Equity gets to keep the interest. If an HSA account holder invests their HSA account into a mutual fund, so you have the cash savings and anything above that you can invest, well, Health Equity gets a cut of the investment advisory fees collected by the investment advisor. So very good. So far we have fees collected, as well as to making money from account administration and the assets in the HSA accounts. Health Equity collects a portion of transaction revenue from its HSA debit card. So when someone goes to swipe to pay for something, there it is. So they kind of have two sides of the coin. Of course, it's more beneficial. The more these accounts grow, the more Health Equity gets to make. But when people do choose to spend the money, they still get to collect transaction revenue from the HSA debit cards. So Health Equity is collecting fees every single month. It's called the toll booth effect. Warren Buffett loves to invest in toll booth companies. Basically, you sit back and you collect these fees every month. So while these accounts have cash or investments in them, Health Equity will be collecting fees. That is a beautiful source of revenue. It's dependable, it's reliable. So now let's talk about the HSA specifically. So total accounts went up 9% year over year. That is good growth. I would like to see it be in the double-digit range, but it's not 1, it's not 2, it's not 5%. 9% is very healthy, so I like that. Now, HSA cash went up 6% year over year. HSA investments went up 28% per year, and the total HSA assets in whole went up 14%. I want to focus on those investments. Now, investments are most important because people that choose to invest their money in their HSA accounts are in it for the long term. that is creating staying power for this company. So the fact that it's the highest growth out of the three makes me even more bullish on this company, because these people are going to be holding their accounts for a very long period of time and most likely growing that cash. Therefore, Health Equity will be able to collect more fees. Now let's talk about some financial data. I created these charts. Let me know if you like them. So regarding free cash flows, you'll see they went from the negative just 2 years ago to now well over $150 million. That is fantastic. Free cash flows are so important for a company. This is the cash that they get to have and choose what they want to do with. Do they reinvest in the company? Do they pay dividends? So on and so forth. It's extremely important to have this metric growing, and it is. Now with revenue, we will see it is growing every single quarter like clockwork. That is due to those fees they get to collect. Again, it's like a subscription, right? You open up an account as a customer, you're gonna start paying fees to Health Equity, not directly, but indirectly through the cash you hold that they invest in bonds, or through the fund you choose, through the administration fees. So this is showing right here the dependable growing revenue that Health Equity is collecting, and it's growing steadily over time. Now regarding long-term debt, we see that this has gone down over the last 2 years pretty massively. But since 1Q23, it's been going up slightly steady since then. So I want to see this kind of start to trickle back down eventually. But overall, their debt profile is not huge. I'll show you here in a minute some other metrics regarding their debt. Regarding net income, they went from a net loss 2 years ago of 14 million to now 26 million of net income. Fantastic. So we're really seeing all these metrics move in the right direction. That is beautiful. Now let's look at the stock facts label I created on Health Equity. We'll see their market cap is almost 7 billion. They're at 6.8 billion. The free cash flows now are sitting at 211, almost 212 million. And right now their price per earnings says 237 almost, but this hasn't updated the site that I pull from, but it's dropped to about 179. So you take the 5-year average of over 1,000, this is showing how fast this company is growing their earnings, and that's great. A lot of companies start out this way, very expensive. People look at this PE, high PE ratio, and they freak out, but you have to think long term, and the growth that is occurring and how fast this PE ratio is dropping means that it should continue that path as they grow. Regarding their price per operating cash flow, it is high to 33.42, but again, you're paying for the prospects of growth. Now, cash flow over the last 5 years grew almost 18%. Revenue grew 16% over the trailing 12 months, very healthy. And over the last 5 years, it's been 28.33, very good numbers. Gross margin is excellent, 68.32. That's more than Google. Just to show you in comparison, love this. Return on equity is low at a 2.82, but I researched the industry average and it said 1.91. So I want to look more into this, but overall return on equity is low compared to other companies. Maybe it's just the industry it's in. I will research this and maybe update down in the comments if I find anything on it. And then we look at the debt profile. So we saw the debt chart. So the total debt to assets is 30.31% and the total debt to equity is 47.47%. When I invest in companies, I look for something below 50%. This is a good debt profile for this company. Of course, I want to see them lower this over time, maybe get the total debt to assets below 20 and the total debt to equity below 30. That would make me very happy as an investor, but this is nothing that we need to worry about or is putting the company at risk. This is a good debt profile, and they do not currently pay dividends. Maybe someday they will. Now let's talk about valuation. Now I pulled this from S&P Global, a company I invest in. They hold a ton of data and they do a lot of analysis and research on many different things, but stocks is one of them. So they deem this company highly undervalued, meaning they are factoring in that this company is expected to grow a lot. And currently, even with that 179 PE ratio, it is undervalued. That's why you have to look beyond that PE ratio. You can't just look at that and say, nope, too expensive. Look at how the company's growing. Look at what they're doing, what the potential of their product is. So the quality-wise is extremely high. That means to me this company's being run really well. Now, growth stability is right in the center, and I think that's because it's in the healthcare industry, and there's always risks with regulation and things like that. And also, HSAs are kind of new to the market, so I think they're just kind of taking it safe here and saying we're 50-50 on this. We'll have to see how this develops over time, but I'm very bullish. I would have rated this higher. Now, financial health is also somewhat in the middle, but as we have the revenue and the cash flows continue to grow, this should get more and more into the healthy range. Now, regarding a price target, we'll see here that they have a almost 24% upside potential Right now they're hovering on $80 per share, but they have a price target of almost $99 per share. And they had a recent dip of 2.5%. So that's when I bought this company, and I'm excited to see where it goes over the next year. I really believe it'll hit $100 before I know it. So it's saving the employer money, the employee or insured money, and the health organization offering the plan money. It's a win-win-win. From the employee insured side, it's not just offering health coverage benefits and utilization, but also an additional retirement savings account. So speaking of the retirement side of things, after you reach the age of 65, there is no penalty if you use HSA money for anything other than healthcare. Before 65, it has to be used for healthcare expenses, but you will have to pay income tax once you do start pulling out for retirement over 65, which is similar to pre-tax withdrawals from your 401k. So it really just is another retirement account, which is awesome, just to be able to say, hey, I have a 401k, an IRA, oh, and this HSA. When I reach over the age 65, I'm pulling from 3 different accounts. How awesome is that? So I think this is an option that will keep spreading throughout the business and health insurance world, with many companies adopting this to offer their employees and save money, because that's what businesses are always after, is to reduce expenses. This is more revenue and fees that Health Equity will get to collect in the future as this adoption spreads. I know more and more people around me personally that are going on these plans, and I do not see that changing. I think that growth will continue. Plus, the way healthcare is going, you might as well be saving and building up that savings for unexpected medical costs in the future. What a great cushion to have. Now, my employer offers this, and another accountant and I calculated costs in many different scenarios for the plan offered, and in most cases, you end up paying way less than a traditional health insurance plan. The longer you have and save with your HSA, the more beneficial it is, because with a higher and higher accumulation of funds in the health savings account over time means you could easily pay for a pricey medical event and not have to pull money out of your checking or savings account. You just pull it from your health savings account. Again, add to that the benefit of being able to invest your funds and utilize it as another retirement fund once you reach 65 is amazing, and in itself worth it in my opinion. The tax savings, the premium savings, it's all very advantageous. So I view this as the future of healthcare coverage, and one that will be adopted at a faster and faster rate as it saves virtually all parties money. Plus, like I said, these accounts are sticky as you invest your money, and you don't want to pull that out, right? You want to see that grow. It's great to see your funds grow. I see this as staying power. That's great for Health Equity. Now, of course, be sure to review the plan and your own individual health situation, as a traditional plan may be best. It's up to you to decide. If you're overall healthy, it is usually a much better option. Which leads me to, we gotta talk about the risks of investing in Health Equity. We can't just talk all about the positives. What are the risks? Well, healthcare companies in general can be challenging investments as they are highly regulated, right? The industry is highly regulated. But to me, I'm not so fearful with Health Equity, because with HSAs, it encourages people to save, and with a high deductible plan, you don't want to go pay these co-pays, right? If you just have a cold, you want to save that money. So it's going to reduce the amount of people going into healthcare facilities for things that they can just treat at home. And the government sees that as reducing backlog and therefore creating a better health system. So I really think that's beneficial, and the government wouldn't really target it, because that's a benefit, right? If that improves wait times and things like that, great. Also, Health Equity must navigate complex and opaque relationships with hospitals, insurance companies, and end customers. So they have 3 avenues of juggling communication, but this company is already established. It already is the market leader, and I think it has things figured out, so that calms my fears there. And the last risk to me is the adoption rate of HSAs. It needs to stay growing, right? We need more and more people choosing these plans. So if they don't, that's a bad thing for a company where its main source of revenue is coming from these HSAs. But for me, based on what all we talked about, I think they're just so beneficial and attractive. More and more employers will continue to offer these, and more consumers will continue to choose these. And so I really think it'll continue on a growth path. And again, I think it'll be a very large market share of what people choose for their health coverage in the future. Also, with the benefit of these accounts for virtually all parties, I see massive potential to be successful. So I'm aware of these risks, but I just see a path with HSAs that will continue to be adopted more and more, and investing in a company that has the clear majority of the market share and competitive advantage regarding HSAs, it's a bet I'm willing to take. So this is my new investment. I'm very excited for the future of this company and the future possible gains my investment will make. Subscribe if you have not already, as I will share the progress of this new investment of mine, regardless if it does well or poorly. Speaking of that, here's my portfolio. I share this with every single video. I'm a transparent channel. I want to show you exactly what I'm investing in and exactly the performance of these investments. Right now I'm up over 20%. And you'll see there in the healthcare sector, I added Health Equity, HQY. I also have Johnson & Johnson, and it's been a dud for me. I've held this company for over 2 years and it's up 2%. I kind of want to sell it. I'm still debating. But with Health Equity, since it's such a new investment, we'll see it kind of jump in the red and green probably for a while. But my bet is it'll be very well into the green within the next 5 years. And I'm very excited to maybe add on any weakness. So let me know if you like Health Equity as my new investment. Do you have any concerns that you see that I might have not have mentioned that would be good for us all to know? Please mention it. So there's more changes coming, but this is all for now. And I want you guys to have a great day. Keep investing and saving, and we'll see you soon on Mark Arnold's Finance.